Good afternoon, this is Sean Golden with Golding & Golding, here to discuss the basics of Form 1116 for individuals claiming the foreign tax credit. Alright, let's go through the basics. So, the US taxes you on your worldwide income. If you're a US person, US citizen, legal permanent resident, you meet the substantial presence test, then your worldwide income is included on your US tax return. Even if, for example, you live in one foreign country, all of your income is sourced in another foreign country, it doesn't matter. If you're a US person, the U.S. is going to tax you on that income even though it's not being sourced in the U.S. Additional side note, you also have to do some reporting, FBAR, FATCA, for foreign assets, accounts, and investments. That's not really about today's presentation, but something to keep in mind in case this is all new and overwhelming to you. Foreign tax credits. So the way foreign tax credits work is like this. Let's say you are overseas and you have earned $50,000 of interest income and you paid $10,000 worth of tax. Now, when you fill out your U.S. tax return, you have to include that $50,000 of income on your U.S. return. Why? Worldwide income. But you are also allowed to include that $10,000 of foreign tax credit. Okay? One super huge mistake that I see very often is a taxpayer will say, well, I earned $50,000 overseas, I paid $10,000 in tax, I'm only going to report $40,000, right? So now you don't get to claim the foreign tax credit on that $40,000. That $40,000 is going to be grossed up for your U.S. income. If you do it the way where you include the full amount and then the foreign taxes paid, then you can normally claim a credit, okay? The idea is the U.S. isn't going to double tax you. Now, excuse me, it's not always a dollar for dollar credit. So let me give you an example. Or expanding on that example that we just started with. Let's say the tax liability overseas is $10,000, right? Let's call it Michelle. And so Michelle is filling out her U.S. tax return. If her tax liability on that foreign income in the U.S. would be $10,000 as well guess what? She zeroes out. If she gets the full foreign tax credit, then she doesn't owe any tax. If her U.S. tax income U.S. tax liability, would have only been $8,000, well, now Michelle has a $2,000 credit that she can carry forward. For this example, just assume she can claim the full $10,000 tax credit that she paid overseas. Now, let's say Michelle is in a high tax bracket and she actually would have had to pay $15,000 on that $50,000 worth of income. If her taxes would have been $15,000, she can apply the $10,000 tax credit and then she still has a $5,000 tax liability. But if she had carryover credits from prior years, she may be able to apply those as well to zero out the tax liability, which is why foreign tax credits are so important, okay? Generally, foreign tax credits are not a high audit risk from the IRS unless you have high credits, which is normally more than $50,000. In that case, then ordinarily goes to the exam unit. Practice pointer to keep in mind, if you're doing things like streamlined and reasonable cause and delinquency, you'll read information, people are saying there's no one ever gets audited, okay? That's not true. And in fact, if you have a high income earner and they're paying high taxes overseas and more than $50,000, it automatically goes to the exam unit and that could lead to an audit. And that audit will normally branch out a little bit from just the foreign tax credits. Agents going to want to know more information. So that's something to keep in mind even when you're doing non-willful submissions. If you're claiming foreign tax credits, go different categories. So you have general, you have passive, within passive you have different categories and treaty and things of that nature. If you're claiming foreign earned income exclusion, for earned income that you have, self-employment, or let's just say employee income, you can still claim the foreign tax credit on that same income, but not on the same dollar. So let's say you earned $500,000, you claim the foreign earned income exclusion, you can still claim the foreign tax credit on that category of income, but there's an equation you use to make sure you don't double dip using the full $500,000 or the full foreign tax credits you paid on the $500,000. You have to include, or you have to at least, you have to take into consideration the foreign earned income exclusion that probably knocked out the first $107,000 of what the potential tax liability would have been on that income so that you don't double dip. If you're using commercial software like TurboTax or something, it will normally take care of that for you. If you're out of compliance for reporting your foreign income, our firm, we specialize in offshore disclosure, and there's various programs that are available. There's the voluntary disclosure program. There's the streamlined filing compliance procedures, which is streamlined domestic and streamlined foreign, both for offshore matters, but domestic involves non-foreign residents and foreign involves foreign residents. You also have other non-willful programs such as delinquency procedures and reasonable cause. We have lots of free information available on our main website, goldinglawyers.com, and our sub websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.